Hi everyone, hope you're all doing well. Today I'm going to do the most popular video series that I do on the YouTube channel, which is the Stocks I'm Buying UK edition, November 2024. So this is where I go through all the stocks that I bought and sold from the 1st of October to the 1st of November on the UK market. I was quite active buying. There has been a lot of weakness, a lot of concerns around the UK budget that's coming up on Wednesday. So I thought I'd buy some of that weakness into the month of November. I will do the US one in a few days' time. I'm going to let you know that there's not many buys on there. I think because I was buying so much on the UK market, I think there was only one stock I bought on the US market over the last couple of weeks, and I actually sold more stocks on the US market than I bought, which will probably be the first time ever that's actually happened, but I'll do that one probably next Friday. But let's get stuck onto the UK stocks I'm buying. There's quite a few on this list, so I'm going to try keep it quite brief today. I probably have a full video on all the stocks I do mention though if you do want a bit more detail. Hit the like button if you're new around here, subscribe. Let's get started. So like I said, there's been a lot of weakness around the UK market at the moment, and I have been buying those stocks up. Now this could look like a genius move, because if we get onto Wednesday and the budget comes out and it's not as bad as what people think, these stocks might rally massively. At the same time, if it's a lot worse than what people have thought and a lot of that negativity is priced in quite heavily into those stocks, then they could go down a little bit from here. So we'll see what happens. I might look a genius, I might look an idiot. If it does go down though, I still have a decent-ish cash pile to try and take advantage of that. So we'll see what happens. But I couldn't believe on the weekend it came out that Keir Starmer claims that anyone with shares does not count as a working class person. I thought this was nearly a video on its own that he said something like this. I saw this on Twitter and I thought, that's not real. This is going to be a fake article. And I Googled it and I found it and I thought, wow, what is going on here at the moment? But anyway, we'll see what happens on Wednesday. Before we do get started though, if you do want to get some free shares from Webull, not personally the platform that I use, but if you do want to go get some free money, some free shares, they do currently have a pretty good offer on, so it's worth just taking up the offer and getting those free shares. I'll put it as the pinned comment in the comment section, but if you look here at the moment, if you do deposit £100, you get 5 free shares. Keep that £100 in for 90 days, you get another 5 free shares. Or you can deposit £2,000 and you get 15 free shares. And if you keep that balance for 90 days, you also get another 15 free shares. So it's definitely worth taking it up. Even if you don't plan on using the platform, go get some free shares, go get some free money. If you're on the Patreon, I did just drop some exclusive content. I did my UK portfolio review for November. So go check that out if you're on the Patreon. 2 exclusive videos a week. If you do want to join, links in the description. Let's get started. So first of all, Money Group. So this has the potential to become my largest position in the UK portfolio. It's currently number 2. It is very, very close to coming the number 1 position and taking over Hollywood Bowl. If I didn't buy Hollywood Bowl, hint, Hollywood Bowl is going to be coming up in a minute. If I didn't buy any of this month, it probably would have overtaken it. So it is getting very close to that number 1 position. I cannot believe Money Group is actually down 28% year to date. For a company like this to be down 28% is a big surprise to me. It has had a bit of a tough time really since the whole COVID situation. Back in 2019, you can see here it used to be a £4 stock. 13 times earnings. This company is normally trading at 18 times earnings, and even if the stock does nothing in the next 5 years, you got a 6.2% dividend there waiting for you. But I believe what's going to happen is this is going to be a great dividend stock, and I do see Money Group returning to a £3, £4 stock in the next 5 years. So Money Group, obviously they own the brand Money Supermarket and Money Saving Expert with Martin Lewis, which obviously is a great media outlet and promotion for them. What they do is they have a lot of different products, from car insurance, home insurance, broadband deals, travel insurance, pet insurance. There's a lot of products they do have. And what they do is they have the Money Super Saver Club as well, which is something they launched in the last 12 months, which basically links up all your policies into one place, and the more you spend with them, you get more earnings, promotions, and that is also used as a bit of a reminder, so that, they can text you and go, hey, that car insurance you have, it's out in 5 days, come get your car insurance with us once again. So it's a great loyalty club that they're building up in the background as well, which has really helped them out. Now, what normally happens is every so often one of these is a big driver of growth for them. So the last year you've had like the car insurance has gone up massively. That's been a very good, strong performer for them. And also travel insurance since the COVID situation. Everyone's been desperate to go on holiday. Now that's calming down a little bit now, is the travel boom after COVID. Car insurance premiums are starting to calm down a little bit now. So we need the next key drivers of Money Group to start coming in. Now, I thought they would have come in by now, but they haven't. The first driver is the energy price cap. So at the moment, the energy price cap is currently on the UK market. When that goes, the energy market will return, and I think that'll be a big driver for them in the next few years. The next thing that will happen is personal loan products. So they offer a lot of like mortgage deals, personal loans, and obviously people take a lot more of them out when the interest rates are lower. Interest rates are not lower at the moment, but they probably should be, and they're probably lower than what they are right now. I can't believe we have interest rates in the UK that's triple the inflation rate. But with the surprise fall inflation that came the other day, it means that maybe interest cuts are going to start coming quicker and faster to the UK market, which would also be a great driver for Money Supermarket, which I am very surprised by that the stock like Money Group hasn't rallied off this news at all since this has come out. Kind of points once again to that people are very nervous around the budget, that even that's not getting priced into stocks at the moment. So I believe in 2025 we're going to have these key drivers of the energy market coming back, and also personal loans and mortgage deals coming back, that it'll be a key driver for Money Supermarket, and we'll see the stock do very well. You can see here they do have a good track record on Stockopedia of growing that revenue, and in 2024 they're expected 43 million. Not much of a growth driver this year, but the profit is going up because they are getting more efficient as a business, and next year they are expecting to go back up to some growth next year, and as well as that the profit will once again go up, as we see here, from 96 million up to 91 up to 98 million, which will at the moment put it down to a 10 times earnings business. And like I said, this company is normally 18 times earnings, which is obviously very good, and you're collecting that in a really nice dividend. So yeah, I'm a big fan of Money Supermarket. It's why I'm kind of willing to put it as my the neck on the line, as so to speak, and say it could be my largest position, because even if it doesn't work out too well on the share price point of view, I'm still going to walk away with a nice dividend in from my point of view. Next one's Card Factory. So Card Factory has had a big tumble in the last few months. I was actually up over 100% on this position in September, and since then I'm only up around about 20% now. Some of that is because of the share price fall, some of that is because I'm averaging up on the position now, and same again, I think Card Factory could come a large position for me. I knew the stock was going to drop off the last update. I didn't think it was going to drop this much, where Card Factory is actually down 12% year to date. That's just shouldn't be happening. 7 times earnings. Historically, this company normally trades around about 12-13 times earnings, so about half the earnings that it normally trades at. Bit like Money Group, you're going to have a 6% dividend yield to even keep you warm here. So if the share price doesn't do anything, you're still going to be making a nice bit of money from the dividend. Or as everybody knows, Card Factory, you probably go on your high street, you've probably got a Card Factory on your high street, you can go and buy cards from there. One thing they are massively expanding into is the gifts. So if you go into your Card Factory now, you probably notice there's a lot more gifts around the entrance and exit of Card Factories. This is something they're promoting quite a bit, is that you also buy the gifts from them. Obviously higher price products, so they probably make better money on them as well, which is something they're keen to do. They came out with an update, and this is what caused the dip in the share price. They basically came out and said revenue's doing okay, as you can see here, but profit before tax got absolutely slapped. They put that down to the higher living wage, and they just need to manage those costs. They said they've got a few ways that they're going to do that, and obviously the Christmas period will be one way, higher scale volume of products being sold. They also did a lot of partnerships, so they've got partnerships with Aldi, and they're going to be the exclusive card seller in Aldi, and other deals as well, like the Reject store, and as well as that, selling higher margin products will help come back on the profitability side of it. So they said, yeah, profit before tax is down, and everybody was a little bit worried, whoa, we knew it was going to be down because of the increased living wage, but not by this much. But they didn't change the guidance, so we'll see what happens. If they do get near the guidance, I think the stock will rally. I think even if they miss slightly, it'll probably rally. If it does stay down at these levels, then that's justified why the share price has fallen off. So it's a big 6 months for them. I think they'll still do okay, and they'll turn it around. Revenue-wise, the company has continued to grow revenue very nicely since the new management team came in. Before 2020, this stock was an absolute mess, a business that was being run very poorly. Since then, Darcy Wilson has come in and done a very good job at the business, signing partnerships like the Aldi deal, for example. From a profitability point of view, the profitability is going up nicely in the right direction, even with the pressures of increased wages going on at the moment. And that does mean if they do hit their full year guidance, it's actually going to be around about 6 times earnings. And like I said, this company normally trades around 11-12 times earnings. So from a P/B ratio, it would be under half of what it normally trades at, and that's not without factoring any more growth in or the dividend that you'll receive from the business. And a little bit of confidence, there has been some insider buying at the moment, so you got the likes of Darcy Wilson, who did buy a good chunk of shares back in June time, as you see here, when the stock was 97p, and when we look at the stock now, it's actually 90p, so that's a really nice confidence sign. And this is a time frame when a lot of insiders have been selling stocks just in case the capital gains tax is going to go up massively as well, so bit of a bonus there. Next one, gaming realm. So this could come a very large position in the portfolio. I can't see another stock apart from Evolution, which is ironic that they're both in the kind of same sort of space, and maybe that's a sign that this space just has weakness at the moment. I've not seen a company like this trade this cheap before. So it's currently 15 times earnings at the moment. They provide a lot of games to the likes of DraftKings, FanDuel, William Hill, and a lot of them are like the Slingo games. And you can see here some of the Slingo versions that they currently do. And they do a couple other things down here. They came off the recent update, which was no concern why the stock is down. The stock is currently down year to date 8%, but yet this company's had a fantastic year. If we look at the recent numbers that they've just done, the revenue was up 18%, the adjusted EBITDA was up 21%, and the profit before tax was up 51% as well. And when you look at this company here, you've got a company that's going to grow at between 15 to 20% going forward. The profitability is moving in the right direction, and in a few months' time, we're going to talk about a company that's 12 times forward earnings. By the time we get to 2025, we're going to be talking about a company that is 9 times forward earnings, that is growing. I mean, let's just go back on Google and look at these numbers one more time. That's growing at 17% on a revenue basis, revenue at 31%. You just should not be picking a company up that's doing these levels of growth at 12 times or 9 times forward earnings. It just shouldn't. You should at least be talking market average of like 20 times earnings, but realistically we should be like 30 times earnings potentially for this stock. I just don't know how it is this so cheap. And when you look at a financial point of view, you know, there's no debt on the balance sheet. They sit on a nice healthy cash balance of 9 million. Remember, when they close the full year in a few months' time and then they generate another 7 million of profitability, they're going to have such a big cash balance as well to do things. I just am shocked at where this is right now. It would be good if some insiders do start buying some shares up just to kind of prove how cheap this is, but I don't think I've ever seen something like this before, and I just don't know why it's so cheap. I don't know if I'm just missing something here, but yeah, I like Gaming Realms. Next one is Barrett Redrow. I know they said Barrett Developments. We've got to say Barrett Redrow now since they have merged together. And yeah, this one is having a tough time at the moment. It had a drop because of the Redrow merger, and then it's just had another drop because of the weaker market out there, which I'm surprised by, because once again, as we mentioned in the earlier chat about Money Group fell with the drop in inflation, meaning probably there's going to be more interest rate cuts. I thought that would rally off that news, and I looked at Barrett and I thought, okay, house builder struggling at the moment because of the higher interest rates, but if you got the news that inflation is coming down rapidly and interest rates are going to be cut a lot faster, surely the house builders are going to rally off this news, and not a single bit of it was priced in. I was like, that's crazy. So I thought, you know what, I'm going to pick some more shares up in Redrow, or Barrett Redrow. They did recently do a trading update, which I thought was okay. There is signs of the recovery starting to happen. They said that they're going to get at least 90 million of cost synergies now that they've merged with Redrow. And if they get anywhere near that, obviously the deal will probably be worth it in the longer term. Looking at the numbers, we're starting to see the rebound in guidance from analysts on the revenue point of view and the rebound on net profit point of view. And if we do these numbers that they are projecting in 2026, 12 times earnings, you've got a little bit of a dividend there that probably will get back increased if the sales start recovering. Yeah, we're just so short of houses in the UK that I think you've got to have a UK house build. And I think there's right now there's so much fear priced in that I think they'll do very well for the next few years. There's so much demand because of these higher interest rates that's built up that as soon as they get down to the 4-3% range, I think the housing market in the UK will go bonkers. Next one is Supreme. I did buy some shares in Supreme. I did sell some of my stock back in August. I just thought, you know what, it's just run up a bit too much. You're going to take some profit off the table. I'm glad I did, because now I can go buy some more shares in Supreme. It's funny that stocks are just not loyal to you at all, and that's why sometimes, even at that point, I thought Supreme was going to go higher. It's just some good to take some profit off the table, and now I can put that back into the stock. I'm surprised how much it has fallen by. It's still up, I guess it is still up year to date 33%, but back at 7 times earnings, 3% dividend yield. They are a distributor of products like batteries, lighting, health and wellness products, and the big division, which is vaping, which is a fast growing segment at the moment. Now, they did do an AGM trading up statement, and they said that everything is going very well. They said trading continues in line with expectations, and you can just see the revenue growth of this business here. And we are expecting to go from 221 million to 242 million this year. 2026 forecasts seem a little bit flat at the moment. I would expect them to start getting upgraded going forward. From an EPS point of view, just look at the development of the EPS. We're now up to 18 pence per share, which is obviously very good, and also the profitability as well, moving up nicely in the right direction. If you look at a P ratio, down at 7. On a forward P, we're going to be down at 7.5. I mean, this is always going to trade at a lower valuation because it does have that exposure to vaping. It's very good growth, but there's also that concerns around regulation, which is understandable. But when you are talking about a company like Supreme, you're collecting a 3% dividend yield, it has a very, very good balance sheet. There's some point where you go, 7 times earnings for these numbers is just too cheap. You know, I would expect it to go somewhere between maybe a 10, 11 times earnings kind of company for these sort of levels. I just think this is a little bit too cheap once again for Supreme, so we'll see what happens there. Next one, my largest position, I did buy Hollywood Bowl. I bought Hollywood Bowl for the first time for around about a year and a half, I think it was. The stock was having a bit of a dip, as you can see here. I thought, you know what, I'm going to buy some shares. It has had a bit of a pop since I did buy, but during that time, the stock did get around to about a 14 times earnings business. It was around about a 4% dividend yield, and I thought, you know what, I'm going to buy on this weakness here. Everybody's kind of seems to be talking negatively about it. I thought, you know, I'm going to buy some here. What they do is they obviously are a bowling alley, and they also have the arcades, the food and drink, and they put them in busy locations where you can tie it in with maybe shopping or going to the cinema. And historically, these venues have done very, very well. And if we do look at the recent update was very good, with revenue up 7.2%. But the big driver of growth is the Canada revenue was up 42%. So this company was historically a UK business. In the last 12-18 months, they have decided to start expanding into Canada, which at the moment seems to be very, very successful for them. So they've got the UK side to keep on growing a little bit more, but there's big potential now for them to become a very similar size company in Canada as they are in UK. And if that happens, I think the company will do very successful. So I did pick some more shares up on Hollywood Bowl, and like I said, first time I bought for like a year and a half. I just thought I'll add into the position a little bit, and that's what I did. Next one, B&M. I did start a new position on B&M. I did a full video on the YouTube channel. I bought a chunky position, and there is an update coming out, I think in like 2 or 3 weeks time. And what I'll do with B&M is if it just drops another 10%, I'll double up. And if it drops another 10%, I'll double up from there. So I pull the trigger on the start position, and then I'll see what happens from there. 11 times earnings. This company normally trades around about 17, 18 times earnings. You get a nice little dividend here of 3.66%. The stock has had a little bit of a fall off since 2023. I think they had a big surge because everybody during that time had a lot of pressures on, with the consumer environment being a bit weak. Everyone turned to a couple of bargain shops. The share price rallied from that time frame, and now it's kind of giving it all back, which to the point of where it is nearly the same price as where it was before the whole coronavirus situation, which probably shouldn't happen because the numbers are being very good from B&M. If we look at pre-COVID revenue, they were around about 3.2 billion. This year they're going to close around about 5.8 billion. From a net profit point of view, they're around about 194 million in profitability, and we are expecting 388 million at the end of financial year 2025, which is just totally different. So there's definitely some gap here between the share price not following the financials, and it looks like those numbers are only going to continue to go in the right direction. And if we do look at the recent update, that kind of confirms it, because if we look at their new expansion, which is B&M into France, that still had very good growth, as you can see here. And that will mean that it'll drop round to about a 10 times P ratio company. And like I said, normally you talk about B&M being somewhere between the 17, 18 times earnings business. And if you were to compare it to the likes of Tesco, for example, the likes of Marks and Spencer's, for example, they are also some stocks that trade at 18, 19 times earnings that are in the retail space as well. So yeah, I think this is looking quite attractive. So I did start buying up some B&M. And the last one on the list is Legal and General. I am mostly picking this up for this dividend yield. To get a 9.3% dividend yield and know that's just going to be consistent is pretty good in my opinion, and that's the reason why I'm buying it. There might be some share price potential with the stock. It has stayed a bit stagnant for the last few years and it is lower than where it was before the whole COVID situation. So maybe the stock does go up to a £2.50, £3 stock going forward. But the most thing I'm going to get is that 9% dividend yield. The average S&P's return confirmed. So yeah, I'm just kind of really buying that for that kind of dividend protection. I also feel like if we are going to see interest rates cut in the UK and more investors are forced to get into dividend stocks, they might be saying, hold on, I can get 9% now in Legal and General or 3% in my cash ISA. That might force a few more people into Legal and General. They are providers of insurance, ISAs, pension savings, retirement plans, and a lot of this is being affected at the moment because of the weaker environment that we have in the UK market. Hopefully we see that starting to recover and you will be able to see here from a net profit point of view, we'll start to see that recovery happening by the end of this year and also into 2025 and put us towards where we were a bit more before the whole COVID situation, and we see that rebound start happening. And on a forward P ratio, that does put us down to 11 or 9 times. This company does normally trade towards like 11 times earnings, so that would be about right for the business. So we would have to see that net profitability go up from about 1 billion here up to where it used to do before the COVID situation, which it can do. If it was to get back up to those sort of numbers, I think that's where we would see some share price return as well from the business. So we'll see what happens there, but yeah, that's a little bit of a dividend play that I also have in the background as well. So those are stocks that I've been buying, guys. I hope you enjoyed the video. Like I said, there's been a lot on the UK side. When I do my US side, it's going to be literally over in 5 minutes. We'll see what happens with the budget on Wednesday. That's probably going to move a lot of them and decide if I do continue buying a lot of UK stocks at the moment or if I'm a little bit more cautious, or maybe the rally. We'll see what happens on Wednesday. But let me know in the comment section what you're buying at the moment as well. And apart from that, hit the like button. If you're new on here, subscribe, and I'll see you in a bit.